What's up, team? This is Ro, your best friend at JMSB. As promised, here I am today to offer you a solution to the homework example that I assigned in our weekly tutorial last week for Comm 217. I'm hoping many of you guys got a chance to look at it and practice it, and here we are today to try to work at it together. So without further ado, let's get right to it. Hit the mic. Ro. Alright, Team 217, so let's have a look at question number 6. Here it says, presented below is the unadjusted trial balance for Great Savers Tutoring Inc. as at December 31st, 2013. So lower down, we're offered the debit and credit balances for the various accounts that exist. These are obviously unadjusted balances as mentioned in the problem. If we now have a look at the required on the next page, we're asked to prepare adjusting entries for each of the following. So in Part A, it says, buildings are depreciated over 20 years on a straight line basis with salvage value of $120,000. Equipment is depreciated over 4 years on a straight line basis with a salvage value of $30,000. The bookkeeper did not record any depreciation in the fiscal year 2013. So this is a very typical adjustment. It's an adjustment to recognize the amount of depreciation expense that has happened during the time period. On your midterm exam, the only method that you're responsible for is the straight line basis. And so that's why it's expected that both the buildings and the equipment are actually being depreciated this way. Under the straight line method, the way that we journalize or record the amount of expense is first by calculating the annual depreciation. And we do so by simply applying this equation where we've got the cost of the asset, we minus the salvage value or the residual value, these are synonyms, and we divide by the useful life of the asset. So annual depreciation expense under the straight line basis is always calculated this way. So this equation is not going to be offered to us on the midterm. We obviously need to memorize it. And the idea behind this equation is to understand that we're amortizing, or rather depreciating, an equal amount of the asset's value every time period. And so now our objective is to apply this equation twice, once for the building and then again for the equipment. And once we've determined the amounts, we're going to be able to record the entry. The original cost of each of the assets is offered on our trial balance. So if I quickly look at the trial balance once again, I can see that the building has a value of $620,000. Lower down, we can see our equipment with a value of $200,000. So these are the original costs of each asset, and then in the required itself, we're offered the salvage values. And so now we can apply this equation by simply plugging in the cost, the salvage value, and the life of each of these assets. And so if we work that out for our building, I'm hoping that you end up with an answer of $25,000 as the expense for the year. And for your equipment, it should work out to $42,500. Now, once you've calculated these amounts, the idea is simply to make a journal entry. Since we're recognizing an expense, we should realize that we're going to debit an expense account simply because expenses are part of shareholders' equity and they lower the value of equity. So the idea is to debit depreciation expense for the total amount of depreciation, which would essentially be $25,000 for the building plus the $42,500 for the equipment. So the total should amount to $67,500. Now realize that depreciation is a non-cash expense. And so the way that we balance this entry is by crediting accumulated depreciation for the building for $25,000 and accumulated depreciation for our equipment for $42,500. I'd like to remind you that the accumulated depreciation accounts are contra asset accounts. These accounts are essentially telling you how much value has the building or the equipment lost since they were acquired. So there we have it. That should be a pretty good response for required A. Let's look lower down and tackle required B. Here it says, Great Savers pays their employees on the Friday of every second week. It just so happened that the fiscal year ended on the first Wednesday of the 2-week work cycle. Great Savers' biweekly salaries expense is $72,000. All employees at Great Savers work a regular 5-day working week, and there is no overtime. So the idea behind entry B is to recognize an accrued expense, specifically accrued salaries expense. The logic is that the expense has happened, but it's going to be paid for later. In this particular case, we can see that the employees have worked for 3 days, Monday, Tuesday, and Wednesday, in the current fiscal year, and they're going to be paid for those days in the next fiscal year. Despite the fact that we're going to pay the salaries later, we have to recognize that the expense has happened. And so on December 31st, we'd want to debit salaries expense for $72,000 divided by 10 multiplied by 3. So the logic behind this calculation is to understand that it's $72,000 as a salaries expense for all 2 weeks, which ends up being 10 work days. So if I divide $72,000 by 10, that's going to be the amount of salaries that the firm pays each day. And now because we want to accrue for 3 days, for the Monday, Tuesday, and the Wednesday, we're going to be multiplying by 3. And since we're not paying this amount just yet, it is not going to be a credit to cash, but rather a credit to salaries payable. When we credit a payable, it implies that the firm is more liable. So there we have it. That should be the journal entry for required B. A debit to salaries expense and a credit to salaries payable. Once again, this is a very typical entry that is required on the midterm during the adjustment process. So I'm hoping that you guys got that, and if you did, I would now tempt you guys to look lower down. Let's have a look at required C. Here it says, dividends of 40 cents per common share were declared on December 31st, 2013, but they're payable on March 24th, 2014. The bookkeeper did not record the dividend. So the idea here is to accrue the dividends. The dividends have been declared, but they're going to be paid for later. I remind you that dividends work like an expense in that they lower the value of equity, but they are not considered an expense. Dividends is not an operating expense. It is not even an obligation of the firm. And so now to calculate the amount of the dividend, we're going to go to our trial balance and we're going to have a look at how many shares are outstanding. So if we look lower down until we find the account called share capital, we can see that there are 67,000 shares that are outstanding. And so to calculate the value of the dividend, we're simply going to multiply 67,000 by 40 cents, since the dividend is for 40 cents per share. And so the journal entry now would simply be a debit to dividends declared. It's equity decreasing for 40 cents times 67,000, and we're going to credit dividends payable. Obviously, the debit and the credit is going to be for the same amount, which in this case happens to be $26,800. So I'm hoping that we get that entry, and at this point, I'd tempt you guys to go on to the next one. So in part D, it says, the company leases a part of its building to a tenant in an unrelated field of business. The balance in the deferred rent revenue account represents the payment for rent covering the period November 1st, 2013 to March 31st, 2014. So in this entry, we're dealing with a deferred revenue. It's as though the firm has collected the cash prior to renting the space out to the tenant. And so at this point, what would be pretty useful is first to simply set up a timeline where we see what date was the lease set up, what date we are at today, which is December 31st, 2013, and when does this lease or prepayment sort of end, which is March 31st, 2014. So at this point, it should be obvious to us that the person had prepaid for a total of 5 months. And now what is happening is that as of December 31st, 2013, 2 out of these 5 months have been earned. And that's because we've rented the space for all of November and all of December. Once we've understood this, we should realize that we're trying to recognize 2 months worth of rent revenue, since we've earned it at this moment, and so we are less liable for that amount. In order to calculate the amount, we need to go to the trial balance once again, and we're first going to have a look at how much was prepaid. So if I look lower down and I find my deferred rent revenue, I can see that $10,000 is the amount that we collected for 5 months in advance. And so now once we have that value, we can simply determine what the amount is per month and then multiply that by 2 months to figure out how much of that $10,000 has been earned. So in our journal entry, we're simply going to debit deferred rent revenue, and that's because we're less liable. The way that we're going to calculate the amount is by dividing 10,000 by 5 so that we figure out the amount for 1 month, and then multiplying by 2 to say that 2 months worth of rent have been earned. So if we work that out, we should be getting 4,000, and we're going to of course credit rent revenue, which is an equity account. We're crediting this account simply because the value of equity is increasing. Let's have a look lower down at required E. Here it says grade savers used up $12,000 worth of office supplies during the year 2013 and purchased no additional office supplies. So in this example, we need to record the fact that some of our office supplies, which is an asset, have been used up. Whenever an asset is used up, the idea is to expense the asset. So the entry is going to involve a debit to supplies expense for an amount of $12,000 and a credit to office supplies, which is an asset, also for $12,000. We debit the expense account because expenses lower the value of equity, and we credit the asset because assets decrease in value by a credit entry. At this point, I tempt you guys to look lower down. Let's have a look at required F. Here it says, interest on the note payable issued on January 1st, 2013, with an annual rate of 3.2% is due as a lump sum at maturity. So here what we're trying to recognize is an accrued expense. Whenever we're dealing with a note payable or a note receivable, we're dealing with the interest on the note. The idea here is to understand that some of the interest has been incurred but not yet paid. So the firm had borrowed a certain amount of money on which it is charged an interest rate of 3.2% per annum, and they're only going to pay this interest when this note matures. So at this point, we want to make an entry to say that some of the interest expense has happened, even though it's going to be paid for later. In order to calculate the amount, we'd first have to go to our trial balance and figure out what is the amount of our note payable. So if I look at our trial balance, I can see that the note payable has a principal of $46,000. And so the idea is to charge the interest for 1 year on this amount, on $46,000. So in our journal entry, we're simply going to debit interest expense for $46,000 times 0.032, which is the annual interest rate. And since we signed the note on Jan 1st, 2013, we can argue that we owe interest for the entire year. If you work that out, the amount is going to be $1,472. We're going to credit interest payable. I remind you that interest payable is a liability, and we're crediting this guy simply because the firm is more liable. The interest has happened, but they're going to be paying for it later. Of course, the amount of the liability is going to be the same, $1,472. All right, guys, so that sort of brings us to the end of our homework example. I really hope that you guys found my explanation to be useful, and if you did, make sure you tell your friends that are taking the class about our sessions. In the meantime, keep well, guys, study well. I'll see you guys next Friday. Bro, out.